Well, we saw some extreme moves and ranges and volumes today in the S&P 500 and a lot of the other major indexes. Some big, long lower shadows this time. So from a technical perspective, I'm going to break down what all that means and how that impacted the market forecast, which you'll find here pretty soon. It really wasn't that much. So what does that mean? What can we now expect now that it's starting to get a little bit crazier in the market? That's not so boring. So now that and also as things are mature, where can we find opportunity for a long-term trade where the long-term return expectations right now for the broad market are coming down as we get more and more extremely higher. So I'm going to look for one of those areas that's been beaten up that's showing a little bit of signs of life for today's trade idea. Let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Friday, December the 1st, 2017. Thank you for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by hitting that red subscribe button right down below this video. Next to that button, you'll see a thumbs up icon. Click on that. Let me know that you found today's video useful. Scroll all the way to the bottom and comment on anything that stood out to you from tonight's market outlook, including any light bulb moments or anything new that you picked up while watching. In the description of tonight's video, you'll see a bunch of links, including one to join my daily Market Outlook email newsletter. Follow me on Twitter for more content in addition to these videos. You'll see my handle on the screen at DavidSettle42. Pinned to the top of my timeline is today's Market Outlook tweet. Like and retweet that tweet from there. Of course, join the Market Outlook community. You'll see the link there on Facebook at the top of the screen. You'll also see a link to it in the description of this video, of tonight's video. Alright, well, if you take a look at the S&P 500 with the market forecast indicator, you can see that we had quite the trading range today. Look at that move. And big, long, lower shadow, big trading range, about over 45 points. Despite that, looking at just the market forecast, you can see we have a 91 on the intermediate line, so still well inside the upper reversal zone, still showing strong bullish posture. A 90, back up over 90, almost a 91 on market sentiment. Which also confirms a strong bullish trend. Extremes and mature in terms of time frame, the length of time. Same thing with the near-term line. You know, with near-term lines now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 days that the near-term line has been above 50. Now that would have changed if we would have closed down here, but we didn't. Brought the near-term line back up, brought the momentum line back up from falling to an extreme low itself. So all that being said, things continue to show bullish trends, but as you'll see with some of these other charts, you know, if yesterday wasn't enough red flags to tell us to start taking off some profits, reducing position sizes, kind of gearing up for an increase in volatility, then today should be the huge red flag, right? The fact that we had such a big trading range, among other things that we'll get into, you know, that yes, the market forecast is strongly bullish, but you know, the red flags are starting to slap us right in the face day after day here. The Dow Jones Industrial Average has an even stronger bullish posture. You can see its intermediate lines at 95, but again, long lower shadow. Whereas the S&P had a Harami pattern, you'll see the S&P again had a Harami pattern here showing, which is a small body inside of a bigger body, and had the long upper shadow. Long lower shadows at the end of bullish moves are bearish too, but not as bearish as the longer upper shadow. So, you know, obviously the bears were in. Bears were in play today. So the bears came to play. I don't know about the actual Chicago Bears, but these bears, they pretty much lost it by the second half, and the bulls were back. Regained the lead and finished the day pretty strong. But the bears were there. They showed up. They showed up for at least the first quarter before giving in. And you can see the Dow Jones Industrial Average, not quite as stark, but the same concept. This hanging man candlestick pattern, which is what it's called. Again, not as bearish as if that was a long upper shadow. If we had that size of move to the upside, boy, we'd be running for the hills right now. But it's still one of those red flags. You know, it's not bearish. It's not, you know, back up the truck and load up on some and get rid of all your bullish trades bearish. But it definitely is take some risk off the table, right? If you have some profits, take some risk off the table, and let's wait for things to settle back down again. The NASDAQ also shows that a strong bullish posture. Its intermediate line is falling, but still easily above 80. Its near-term line did drop below 50 here yesterday and bounced up today. So, you could say, hey, well, we hit on the intraday basis. We hit some support. We may be bouncing here. There's a couple of haramis on this kind of sharper pullback. We never really got an extreme low point on any of these momentum lines. Even though here we did get it below 20, so we had an intermediate confirmation signal right there. Not necessarily the best buying signal, buy the dip pattern, and we talked about that earlier in the week. This is a little bit better buy the dip pattern, all right? If that long lower shadow holds in this case after a pullback. Remember, the NASDAQ pulled back. The others didn't, but the NASDAQ did pull back. So that's something to keep in mind to see if that will keep the large caps going. And if we look at the Russell 2000, that long lower shadow looks even worse on this one. And again, it didn't pull back like the NASDAQ. It was the only one. So its near-term line didn't drop down below 50. And there is a definite near-term divergence here. Lower highs on the near-term line corresponding to higher highs. For a brief period of time, we did hit that low point at 15.15 roughly, which is this old high, and the low point in between that corresponds to that. So definitely a bearish divergence with mature posture and a bullish trend, a bullish intermediate trend, which would also be a higher high with lower highs here on the intermediate line. So that would also set up the potential for an intermediate divergence, which would set this area up at 1450 for the target to the downside. So we've got a near-term divergence target at 1515. You break that, and we're looking at the 1450 for the next area of support, again, based on those divergence patterns. All right, the long-term chart, you can see that this is a strong week. It's what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of the last 12 weeks. And then you can count 12 out of the last 13. Well, no, 12, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 out of the last 14 weeks. And if you count that, 12 out of the last 15. So, that's quite the run, quite the extended rally off that August low point. When you look at it from this point over that 15-week period, we're up 12 of those weeks. We're up 9%. Annualized out 35% return for 15, about a quarter. A little bit more than a quarter, 15-week period. So strong bullish move off that intermediate low point, and you can see previous intermediate low points to when we finally peaked. We had a 6.3% move, 22% annualized return, and of course the big one here off the election before we finally peaked. We're looking at 119 days, 51% annualized return over that period. A little bit more than a quarter, about 4-month period. But a 51% annualized return. So not as strong as that post-election, but pretty darn strong at 35% annualized return there for a quarter, a little bit more than a quarter. It's a darn good return, and you can see we're well up above the 200-day moving average. You can also see that we are the 50-day moving average is well up above the 200. And if I take a look at the 3 green arrow chart, again you can see that we have the MACD and the stochastics still at high levels. The stochastics can't really get any higher, and we're not closing again at the highs. We came close today, but we're not closing it. This is like the 3rd day now in a row. You don't see that. The November 30th day is not on here for some reason, but you don't see that November 30th, that long upper shadow there. So 3 days in a row, not really closing at the highs, and the highs were earlier in the day more than they were later. Even though we did finish strong today, and we had a good update yesterday. That's why your stochastics can't stay kind of at the extremes, because we're not closing at the extremes. We're not closing at the highs. But 3 green arrows nonetheless, strongly bullish, and again, well up above the 8-day moving average. Again, I can just take turns looking at this. So we'll bring this study over here, and we'll look at current price. Current price to the 8-day moving average first. We'll take off that signal line, and then there's your 8-day. So extremely high off the 8-day. If I take a look at how far up above the 30-day we are, which is that 6-week moving average in blue, we're 50 points up above that. And again, for context on when that's happened before, when we've been this strong up above before in the recent past, it was right there, that kind of October 5th. And, we didn't go down, but we just kind of went sideways there. You can see it again, March 1st. I brought this one up before, but before that, we were that far up above here. Now, again, we were a lot closer to the beginning of a intermediate trend. In fact, no, again, excuse me, sorry. We were at the end, similar to what we have here, we were at the end of a 3-month move. Market sentiment was high. We were at the end of a 3-month move here, already mature intermediate posture, and it continued higher to it, even into that big blow off that we had in March. So again, there's precedent for us to be in this mature posture where we had a little bit of a weakness, an intermediate trend, but then continued. And again, whether tax reform will cause something like that to occur here or not, or we've already had that, if this was our kind of last move, this bullish move is our last move. It remains to be seen, but we are already well up above, well off of these major moving averages, and it's. We've seen we can, but this was, this February move kind of came out of nowhere and blasted us up higher, and then we ran out of gas and we were done for 2 months. Didn't break the long-term trend, but we were kind of done for 2 months there. So the posture is strongly bullish, the trend is strongly bullish, but the fact that we're up above this 8-day and these 30 days and the 50-day and all these strong moving averages, this suggests that, not closing positions, but taking risk off the table. Where's your risk right now? Well, when you start a position and you put your stop order in, your risk is the smallest at that time, right when you get into the trade, and because you already know what you're going to lose, you set in your stop order with the idea that I'm willing to lose this much, so your risk is set and it's as small as it's going to be. Once that position takes off on you and you get some gains, now your risk in the trade gets bigger and bigger, because you're risking that initial amount, that loss amount that you're willing to get into, but now you're also risking profits. So you've got more risk than ever on that trade as it's moving your way. Now you can reduce risk by moving stop orders up, which is one way, which is your portfolio risk, which is the amount you're willing to lose in the worst case scenario. So the stock comes down and blows through. Or, excuse me, that's your trade risk, sorry, that when you hit your stop order, that's how much you're willing to lose from current levels to your stop price, so how much you're willing to lose per share. So you can move up your stop order and reduce your trade risk, and keep your portfolio risk the same, or you can reduce your portfolio risk by closing some of your position. So now I'm kind of locking in some profits on that. I can move my stop order up as needed, right? And instead of moving it up because I'm worried about my risk, you don't want to move up your stop order until you have a new support level, or your rules and your plan tell you, now I'm in this condition to move up on my stop order. You don't just want to move it up when there's not a significant support to keep you up above it, right? I mean, that was the initial, when you get into a trade, that's why you put it there initially. There was a significant support there to keep you above that. But so instead of moving that up when maybe your rules don't tell you to yet, you say, okay, I'm going to reduce my portfolio risk by closing a quarter to a half of my position. Take those profits and can't lose them now, so I've reduced my risk. Can't lose those profits now. Now I have the risk of opportunity cost if we keep running high, but that's okay, right? I mean, we know we've already run really, really high. We're very mature. The upside potential is less, even though it's there, it's less than the downside potential. And so because of that discrepancy there, then I'm going to, I'm willing to take that opportunity cost and just take some of those profits off the table. Now here's where things get a little dicey. You can see, obviously we had a lower high and a lower low, but as I mentioned on Twitter today, for those that are following me, today's low point never did get to like danger zone. The danger zone, when you're bullish, is the lower half of the 4-week range. And you can see that lower half is probably about 260.5 in this area right here. We never did get below that during the trading day, and so that's kind of what I mentioned in my tweet was, you get below 260.5 and now we're worried about things. Anything like this, anything in this upper half is just noise, because like we mentioned yesterday, the range is really expanded, and once it expands, it's hard to keep expanding, and so it's just going to, you know, do a lot of noise in this upper half of the chart. It just happened to be very, very noisy today, and you can see when I look at the range, the volume was more than 3 standard deviations, 162 million. The trading range, 4.5 points. So when you put that in context, 4.5 points is way outside the 52-week range. I mean, we're almost right back up to that 1.75 high for the last 52 weeks in terms of the average true range here. The volume, again, also well outside. I mean, very, very extreme. So the good news is, from a bullish standpoint, is, you know, when these lines start coming back down, then that just means we're going to grind higher with small bullish moves. So good news from that perspective. Little bit of a heads up is that we've been above these numbers that we're kind of at right now in terms of averages are relatively low compared to where we've been in the past. And if I were to zoom out even further, you can see this 1.75 looks really high because that is the high for the last 52 weeks. But you know, we've seen highs. In fact, even at the beginning of 2016, the average trading range was over 3.5 points. So I mean, that's when it gets that high, now we're talking good buying opportunity. Here we're talking, okay, well, last time we got this high on the average range was at that low point. I mean, it was a low point. We were pulling down. We're not pulling down right now, and that's a little bit of a concern. And the same thing over here. You know, we had, you know, that range up to 1.75 points, but it was after a multi-month consolidation. Then we rallied, and the line came down. And again, last time in the year was over here. But you can see it was, again, after a multi-month consolidation, and then we rallied as it came back down. So here, we're not at the end of a multi-month consolidation. We're kind of blowing off at the top. So that's a little bit of a concern from a bullish trending standpoint. And of course, volatility took off. Here we got up above 13.5. Now, just for some context, the last time we got above 13.5 was November the 15th. So if I were to go back on the chart here and take a look at November the 15th, there we go. So November the 15th, you can see we had a pullback. You know, we came down, and it was, you know, this isn't the market forecast, but here, let me bring this back over. So there's your November the 15th. You know, yeah, we had how many days? 1, 2, 3, 4, 5 out of 7 days that were down. You know, we brought the near-term line below 50. The near-term line is not below 50 this time. The VIX got all the way up there, and now, granted, it would have if we had closed there. But look how fast the market came in and bought that dip on an absolute basis. On a relative basis here, you can see we have blown through 1. So the VIX had jumped up that far. And again, all the volatilities in the next 30 days, the 90-day volatility is not jumping up nearly as much. So that's why this rallied so far today. In fact, if you take a look here, here we go. So we'll look at, we'll look at this one. We'll look at the VIX, and you can see the range. You know, it got up to above 14 today. The VIX did 14.5. If you look at VIX 3 months, which is the new 90-day volatility, you know, it got up to 15. But you know, at some point in time, the VIX was higher than the VIX 3M. So you know, that kind of gives you an idea. That's why, you know, the ratio got up above 1. Because the VIX was briefly high. Now, it didn't last very long, and it came back down, but you notice it's still kind of in that area. It's still higher than what we've seen, you know, since that November 15th. So November 15th, we got up to that 90 level, the bottom end of the neutral range, 90-95%. So it seems like we're working our way there again. Yes, we're getting long upper shadows, so definitely, again, another relatively positive sign. But the increasing volatility on an absolute and a relative basis suggests, you know, things are getting a little dicey. The bigger ranges, bigger volumes, all of that are saying things are starting to get a little dicey here. And that increase in volatility, while it hasn't turned into a pullback yet, you would start to expect that it will, because higher volumes and higher ranges don't push us up higher. They do off of lows, but they don't push us up higher when we're already at pretty extreme highs and mature highs. Now, as we talk about what's driving the action today, quick reminder, follow me on Twitter at DavidSettle42. You can see the web address up here at the top. Follow me there for more content throughout the day. And also remember, too, to like and retweet the Market Outlook tweets, at least, if not other tweets that you see as well, because the more you do that, the more Twitter will push my tweet to you and to everybody else that follows me, too. All right, so we'll take a look at the calendar today. Obviously, the biggest news was what happened with the guilty plea and how that may impact the administration. Of course, that can impact expectations for any kind of policies to get driven through. But you'll see from an economic perspective, this kind of got pushed down the limelight. The PMI manufacturing number came in, strong number, but a little bit below expectations. So that came in this morning. The market USM, the ISM, the other one, the major one, the one that's kind of more watched. Again, very high number. And, this number here, was the highest we've seen in years. So we're at very, very high levels. And again, these are surveys. These are not hard data. These are surveys of what manufacturers are expecting. And of course, we know they're expecting some very positive things because of the expectations of this tax cut coming through. So here is something that's a little bit more hard data, and this is year-over-year construction growth, which is at a low point, a little bit higher, so that's positive, but that's at a low point right now. So again, a lot of sentiment that's not transitioning yet to hard data, but it's the possibility is there, and that's why you see the economic surprise index so high. You also see with the idea that there's enough votes to pass this Senate tax reform bill, that now the Fed could be more hot. There's precedent in the past when fiscal policies come in that the Fed doesn't believe is needed yet. So for an example, we have we don't have 3-4% economic growth, but we have 4% unemployment. We have very good labor market. We don't necessarily need such accommodative policies. I mean, the Fed doesn't feel like we need accommodative policies, but the fiscal government is the administration is suggesting that we do. And so there's been past precedent where if the Fed believes that fiscal policies are too accommodative, that they would that can feel like it can ramp things up and make that inflation explode, then they'll come in. The Fed will come in and start raising rates faster. And you see that here. You can see here's your expectations for 2 rate hikes by June. So there's the 1 rate hike. So we already have 1 in December. So that's baking the cake. We're looking at 2018. So the red is 1 after December, after the rate hike in December, 1 more in 2018. The gray is after December, 2 more in 2018. The purple one is only the December rate hike, so none. And you can see how that's falling like a rock now, below 20%. And look at this one down here. This line is the 3rd rate hike by June. So that you can see now that the futures market's reaction to this Senate tax reform bill is that the Fed will get more hawkish than expected. And of course, that can have an impact on these asset class prices. So looking at how they performed today, crude oil rallied up on this OPEC news that they can keep inventory levels lower, a deal to keep inventories lower. But you can see on the other end of the spectrum, bonds and gold rallied initially on the Flynn news, but then off of their peaks and stocks corresponding lows, you can see they dropped and they dropped back down. So yields are responding very positively and bond prices falling, but yields are responding very positively to this idea that of these interest rate hikes. Not surprising that the sector that responded the best was the energy sector. It started strongly, and then off of that low point, financials were the one that took off, because again, those rate hike expectations took off, and financials really are liking that idea. And you can see gold, but you can see energy stocks kind of lagging a little bit in the afternoon, but starting the day very strongly, and have had now a good 2-week period. So there's financials, there's industrials, we've talked about those here lately, but then there's energy up there with consumer discretionary. Those have been the best 2-week gainers over the last little bit. If I were to zoom in, since the near-term rally started right here, we've been kind of alternating back and forth in terms of leadership, right? We had technology was a leader, and then it fell off. Financials, but then they had a couple, they took off, but then they had some weakness. Energy took off yesterday, and so you can see eventually technology just has had a bad. I mean, again, this is the current near-term run that we're on right now. Industrials, consumer discretionary has had its run up there, and then there's financials, consumer staples. But see, energy, which was significantly lagging, was down here with utilities and real estate, which you'd expect when yields are rising. You'd expect those to be pushed down, but then the last couple of days have been really, really good day for the energy sector. And the energy sector, when you look at it on a relative basis, here, let's take a look at, on this chart, go back to this kind of long-term view. We'll look at XLE relative to SPY on a long-term basis, and you can see it's been really down since that 2014. If I go even further, it's at 2014 when the dollar started to take off and crude oil tanked. But it's right there. But if you go back even further to the recession, the energy stocks have just been hammered. But things are starting to look up a little bit for them. You have a little bit of a this is again the relative strength on, right? You have a little bit of an inverse head and shoulders pattern, and we've had a strong move today, and again in the relative strength of XLE to SPY. So as you know, for the trade idea, I like to take advantage of that potential, and you can see again, if I take a look at the 1-year chart for Halliburton, one of the biggest companies in the S&P in that sector, you can see that same potential head and shoulders pattern developing. If I were to take a look at the 3 green arrow chart, you can see a spike in volume, big spike in volume. In fact, if I go to the intraday and take a look at it on the standard deviation basis here, there we go. You can see 3 standard deviation coming up off this low point at 41. 3 standard deviations volume on a 3 green arrow signal. So the MACD, well, close to the 3. The stochastics isn't quite up above 25 yet, but definitely up right above 20 yet, but close, 19.91. MACD is above its moving average, stochastics is above its moving average. The price is above all these moving averages, including the 30-day, which is what gets the green arrow there. The 8 and the 17 you would expect to come bouncing along. From a Bollinger Band perspective, bouncing back up through the middle band, you'd expect it to come back up now and reach and potentially test that upper band, so we'll keep our eyes on that. So I mean, there's opportunity here. Now, whether the opportunity turn, I mean, look how long it's taken months for this pattern to develop, and you've got, a neckline at 48, 46. Your low points here about 38 and a quarter, so about 8 points on top of 46 will put you at 54, which is going to run you into this. And you can see the top end of this is about 58 and a half. And again, if I were to zoom out on this to see where we've been, that was a strong level. Remember here, let's go to a longer time frame. Let's go 5 years. So remember that 2014 here is where it peaked at 70, and you can see how we came all the way down in 2016. We had a great year relative to the market in 2016, and now we're kind of forming a low point similar to this one. Is there opportunity now to come up off this higher low on a long-term basis and get up to that high, if not get up to a higher high? Well, but if it does, this head and shoulders pattern is taking months. It could take months for this to come out. So can we do a bullish trade that's cheap that could take months to play out? And of course we can. Of course we can always just buy the stock, but if you want to do it cheap, we can. These what these leaps are for. We can go out to this January leap. So the one for 2019, that's January the 18th in 2019 is the expiration. A lot of days out here. You can see the options are relatively cheap. I can go out to that 50 option, the first one that's below 40, put a buy it for 250 essentially, put the whole thing at risk, right? This position size for the whole 250, because that's per share. That's a lot cheaper than $43 per share. So we can position size around the whole. But it doesn't mean we'll take it, right? If we break through 41. Here, if we break through 40 even and get back down into the mid 30s, we're done with the trade. The basis for making the trade is done. But now we've got this 3 green arrow signal. We've got that long-term inverse head and shoulders price pattern, and we've got now a long-term option that's really cheap. I can get some leverage, and you can see if it does make it up to that 57.5 right here, By expiration, that's a $600 gain. For a $250, that's more than a 2-to-1 reward to risk ratio. And of course, if it happens, say, in the next 6 months, give it a 6 months, then we're looking at about an $850 gain. So more than a 3-to-1 reward to risk ratio with a really, really cheap risk. And again, that's at full $250 risk. Of course, we're not really risking the full $250 because we know if we get down into here, then, you know, even by 6 months, if we get down to 38.5, 36, then we're looking at $140 instead of $250. So we're probably going to end up risking about half of that full max loss, with the potential of getting, you know, a really decent reward to risk ratio if this long-term trade plays itself out. So I basically have bought myself some time to be really, really patient with that trade, and this trade that's really underperformed for years, that's showing some signs of life. Well, if it signs of life turns into a long-term move, I'm positioned for that. So to summarize, the market is still strongly bullish, but it's definitely not boring anymore. Remember, we've talked about before, when the market gets really boring, what can we do when there's nothing to do and make trades? Well, the market's not boring anymore. Volatility is picking up. So I broke down today, you know, what that means, what that increase in volatility means. And to say, okay, well, if things are really mature and bullish, not every area of the market is that mature. We found that energy sector, which has been lagging for years and years and years, showing some signs of life with an increase in crude oil today, coming up off a potentially a higher low point. How can that impact these energy stocks that have been lagging for so long? They're showing a strong technical pattern. So there's a really cheap way to make a long-term trade, manage our risk, but give us plenty of potential to the upside in case that long-term trade pans out. Thanks again for watching tonight, everybody. I hope you all have a great weekend. Remember to subscribe, like, and comment on today's video on YouTube there. Also on Twitter, remember to like and retweet today's Market Outlook video. And of course, if you haven't already, join our daily email newsletter as well as the Market Outlook community on Facebook. Again, have a great one, everybody. We'll see you on Monday.